Hey everybody, welcome to this free edition of our Trader User Weekly Roundup for the trading weekend in July 26, 2024. I'm Preston Brent. Thanks for tuning in. Well, the theme this week is the Feds are on deck and rotation continues. So let's take a look at what happened this prior week. You can see here in the markets that it was almost exactly a repeat of the prior week. Stocks recorded mixed returns for the second consecutive week. Small cap and value shares continue and outpace the large cap growth. You can see here both the Russell and the Dow being more value, Russell being more small cap. They finished in the green. The Russell's doing very well. Look at the Russell. They're up double digits year to date. All of the gains in the Russell for the year have essentially been made over the past few weeks. It was almost very similar to the prior year. And if you look at the Dow, up 7.69%. Now, S&P and Nasdaq still doing well year to date, but just a very bad week, especially the Nasdaq. Um, in fact, the S&P this past week on Wednesday sold off by more than 2%. That's the first time since February of 23, over a year ago, that we've seen the S&P fall more than 2%. Nasdaq had its worst loss since October of 2022 on Wednesday. A lot of it contributed by a huge decline in Tesla, over 12%, and of course Google had a 5% decline following their earnings report. So that also contributed pretty heavily to the market's declines on Wednesday. However, as of this Friday's close, just so that you know, analysts are still saying that earnings in Q2 are going to come in around 9.8%. At least that's what it's looking like right now. So still we're seeing some strong earnings, but we're getting that rotation, right? And the AI stocks that have done so well this year probably are going to be pulling back, because I think there's a little bit of a rational exuberance, or a little bit of too much enthusiasm in those stocks. But the money's not coming out of the markets. It's just going in other places, okay? You can see the PE ratio, the trailing 12 month is at 23.6. The forward PE ratio is at 22.1. So still fairly high, all right? You can see the 10-year Treasury yield came down to 4.193%. The earnings yield for the S&P still a robust 4.45%. The VIX was pretty much flat for the week, but it did see a high number during the week. Not quite 20, but it came pretty darn close. And then it settled back to finish out the week at 16.39. Now look at the best performer for the week. Of course, it's utilities. That ETF and that sector is like a proxy for bonds, so it tends to do well in a very volatile market. And the worst performer for the week, discretionary, down 2.77%. You can see financials, believe it or not, are now leading the way year to date, over 16%. It came out of nowhere. Discretionary, still in the green, but down. It finished 2.57% for the week. So we had a strong Thursday, Friday, and the close that kind of helped out. But overall, the S&P and the Nasdaq were down for the week. I mean, if we look at the economic calendar for this week in housing, we did see new homes sold was down to 617,000. They were expecting 640,000, so that came in lower than people thought. But on the consumer spending front, we did see jobless claims. It fell more than expected. And we did get US GDP that came in at an annualized rate of 2.8% so far for Q2. That's the first pass. That always tends to move the markets. That was positive for the markets on Thursday when it hit, much higher than expectations. And by the way, that was almost double the first quarter pace. So strong initial print for Q2 GDP. Remember, consumer spending is about 70% of US GDP. So when consumers are spending, which is what it's showing, that's a good thing, right? But the consumer market's very bifurcated. Most of the consumers that are spending are those that make more than 70,000 a year, and then everybody else, which is the bulk of the market, are tightening their pocketbooks. Okay. The other thing that helped the rebound towards the end of the week, we did get the personal consumption expenditures. That's the PCE on Friday. It rose just a little bit more than expected, but it kind of stayed at an annual rate of 2.6%, which is not far off from the Fed's 2% target. All right. So that pretty much slotted in, and the markets are slotting in a rate cut in September. Now, I will remind you guys that the markets are expecting a rate cut September, November, and December. That's 3 rate cuts at the end of the year. I think at best it will be 2, but probably 1, unless the Feds have to cut because the economy is slowing down faster than people think. So we just have to pay attention to why the Feds are cutting. And then, of course, if we look over in the European markets, you can see they kind of sagged a little bit, just flat, slightly up, slightly down. You can see the CAC 40s back in the red again. They kicked off their Olympics this past week to a rocky start with problems with their train system getting hacked. There was a bomb scare in Sweden. So there's a lot of things going on there in Europe. But the markets were fairly flat to slightly higher across Europe. You can see the Euro stocks, which are an index of the 50 largest companies in Europe, that came in just slightly in the green. Year to date, they're all fine except for the CAC 40 ever since Macron had their snap election. And he actually drove the French economy more liberal, believe it or not. So they're going to be hurting a little bit. And then, of course, if we look over at, oh, and by the way, there's the ECB, there's a 50% chance they priced in, I guess the markets, European markets have priced in 50 basis point of interest rate cuts for the remainder of this year. So that probably means we'll see a cut in September and probably one in November or December for the ECB. At least that's what the markets are forecasting. Then, of course, if we look at Japan, wow, what a downside move, 6% for the week. Well, the yen is strengthening, so that hurts their exports. I've told you guys, especially our members, you want to be long the yen longer term. It's going to be moving higher. The Bank of Japan meets the same days that the U.S. Feds meet next week. So investors are going to be looking to see if they're going to raise their interest rates. Now, raising their rates hurts the Japanese exporters because now their goods automatically cost more money. It's also raising their interest rates, their 10-year Japanese government bonds up to 1.06%. So, but Japan and their CPI now, that came in a little bit higher at 2.2%. Japan is still putting stimulus into the economy. They're still wanting to see more inflation because for the past 20 or 30 years, they've lived in a stagflation, flat market. So they're really trying to goose their market. That's why they got all that stimulus. That's why the markets were so high. And now we're starting to see the effects of a stronger yen. And then meanwhile, China, you can see China had an ugly week. Hang Seng had an ugly week. China year to date is just barely in the green. Hang Seng is in the red. Equities fell across China because the central bank there, the People's Bank of China, surprised the markets and cut their rates. Now that comes on back of other rate cuts, and it doesn't seem to be helping their economy much. That's why China fell as much as it did for this past week, right? It's just showing China's growing urgency to support growth in their marketplace, but they're having a hard time. Meanwhile, they're just wrapping up their third plenum. They meet once every 5 years, all the head muckety muck government officials in China. They're not people elected. It's who you know, I guess. But they met and they didn't come out with any expectations of doing many other changes. Markets were hopeful that they would, but they didn't. So that also helped add to the bearish sentiment going across China. I'm going to switch the screen here. Let's go over and take a look at some of the key markets. And you're going to see here, let's start with the E-mini S&P 500 futures. You can see they're off year to date, not that much. I mean, it's a barely a pullback. You can see the 50 EMA. It rested on that on Thursday or Wednesday on that big down move. And then Thursday it moved up, but it couldn't get over the 50 EMA, and then it climbed back up over the 50 EMA on Friday's close. You can see my projected pullback points are around 5,300 and 5,330 to 5,350. So I'm not entirely convinced yet that the pullback is done. Remember, this week is going to be a key week for the Mag 7 stocks. We get Microsoft Tuesday after close. We get Meta Wednesday after close. And we get Apple and Amazon Thursday after close. And we get the Fed's meeting on Wednesday. And we get the first monthly employment numbers. So we've got a very active week coming up. So the markets are going to remain very choppy. Volatility is going to remain bid. So that means that vol can pop at any moment. So it'll be a very interesting week. And any change in any of these numbers. So you saw what happened when Google came out and Tesla came out and they missed. It pretty much dropped the markets. It set the tone for the markets this past Wednesday. Okay. Now, this week, they're kind of spread out all week with the Feds and the FOMC doing their policy statement at 2 p.m. Eastern Standard on Wednesday. And then 2:30 Eastern Standard, we get Boom Boom Powell. That would be Jerome Power Ranger, Boom Boom Powell's press conference. We'll see what he does on Wednesday. That can always move the markets. The markets are expecting 3 rate cuts this year. The Feds are on record as saying 1, but I think uh, Boom Boom Powell, he just seems like he wants to cut rates. So I think we're going to get some kind of semi-dovish statement there, but he's not going to say much more than that. So I think it'll be a net effect of basically neutral in the markets. I think the earnings are going to affect the markets even more this coming week with these companies coming out. Okay. Now, if we come over here and we look at the, let me just show you the Nasdaq right here, Nasdaq futures. You can see the Nasdaq futures have blown through their 50 EMA. Right now, S&P's sitting right above their 50 EMA. They've blown through. So remember, once you blow through the 50 EMA, but you're sandwiched between the 50 and the 200, generally you're going to have a retest of the 50 EMA. That would suggest the momentum we saw on Friday could continue into Monday. Monday's going to be a quiet day, and then all heck starts to break loose with key earnings on Tuesday, Feds on Wednesday, and then another Mag 7, a couple of stocks on Thursday, and then the job numbers, monthly job numbers on Friday. So we got Monday as kind of a day off. So we should see momentum probably continue a little bit, and then we're going to get some action. All right. Um, and well, like I said, I see a little bit of a rally, and then I'm not sure if the drop off is ended yet, but we'll know that by the end of this week once we get all these Mag 7 stocks out of the way. Now, if we look at the Dow and the Russell, let's look at the Dow first. These are value stocks. You can see here, it actually never did come down and touch its 50 EMA. In fact, it moved over its 50 EMA back in the middle of June. And we're sitting right around my target area here. So it is having a strong week and it's outperforming. And then, of course, the Russell, as I said before, if you stayed out of the Russell and then just got in just a few days ago or about a couple of weeks ago, this is where you made your money for the year. All right. As I said, the Russell is up year to date, roughly a little over 11%. Right. And you can see it's near its 2024 high, up 12.71%. And the Russell's regained one of its subsloping trend lines. So here is huge rotation going on. And just to show you this, let's take a look at the equal weight, a ratio chart of equal weight over the SPX. Look at this movement here. This shows you that the equal weight stocks, everybody but the MAG, let's call them the MAG 10, so the other 490 stocks, they're outperforming the tech and the AI companies, just very strong, straight up. And then, of course, if we look at just the equal weight by itself, let me find that on here, just the equal weight, no ratio. You can see here the equal weight is also moving up like the Russell. They kind of go hand in hand. You can see here this sideways action, the same as the Russell, and then it just took off. A little bit of a pullback. I think we're going to come back up. So right now the rotation is continuing across everything, right? I mean, they're continuing through. And of course, if we look at volatility, if we look at the VIX, you can see here the VIX, it came down hard on Friday. We intraday, the high in the VIX intraday was 1936. Now, I did tell you guys that we should expect a 3 to 6% pullback. The VIX will probably move into the high teens, which is what it's done. And now it might settle in down here. And then where we get these earnings coming up this next week in the Feds are going to be the big thing. Remember, the markets right now are focused on earnings and interest rate cuts. Inflation is pretty much in the rearview mirror, meaning it's pretty much over and done with, meaning we don't see inflation going back higher. We see it holding steady to going down. When I say we, I mean the markets. And the markets, therefore, are pricing in more rate cuts because they see the economy starting to slow down. Even though consumer spending is very strong, if you look underneath the covers, it's a lot weaker than it looks. Even though GDP, as I said, came in at 2.8%, first pass it for the quarter. If you look at the details behind it, a lot of it was government spending and inventory build, right? So that also positively affects the GDP. So we'll see how all of that stuff shakes itself out. If we look at the front month vol skew right here, just to kind of see where that's sitting right now, you can see it's still in the red, so we're in a backwardation. So there's still some fear in the markets, near-term fear. And until we get through these mega cap earnings and get probably about 60, 70% of the way through the earnings period, and we get the a more clear-cut picture on the economy and interest rate decision, I think volatility is going to stay elevated. But of course, if we go to the back month, if we look at the skew going to August and September volatility futures, we're in the green. All right. And then if we go out and look at September against March, that's the 2-8 spread and vol skew, you can see it's solid in the green as well. So the fear in the markets is more near term, which we would expect with the Feds coming up and big earnings coming up. So that's kind of what I'm seeing here. And of course, if we look at the bond market, you can see interest rates came down a little bit. We're making higher highs, higher lows. You can see this ascending triangle here. You can see that dotted line and then this rising line here. So essentially, we're going to break out. And then the forecast, this pattern would suggest a breakout to the upside because it's higher lows. We haven't made any higher highs yet, but if we break out that high there, that means bonds are going to go on a run, which means interest rates are going to come down. And we may see that this week, depending on what the Feds talk about. All right. So that's going to be a key breakout for the markets. Remember, lower interest rates are also going to help the equity market. Of course, if we look at the US dollar, that's probably more bearish for the dollar than bullish. You can see the dollar's broken both the 50 and the 200. It's coming up and testing the 200, but it's not breaking out above, so it's holding right here. I don't think it's going to get back up much higher, and if the Feds are a little bit more dovish, more interest rates come in, you're going to see the dollar fall back off again, which would be bullish for the euro, because if we look at the euro, right? Here's the euro. It's made a good run up. Now it's settling in. This is a buy the dip on the euro, and we're a sell the rally on the dollar. But my favorite one, though, has always been this entire year is the yen, right? I was telling you guys, you want to be long the yen. In fact, I started saying get long the yen back over here during these bottoms here. And you would have suffered just a little bit, but not much, because the risk of the bigger move is always upside in the yen. You could see it ran up to the 200 EMA and ran into a wall, but I think that's going to break soon and we're going to continue on a run in the yen. So you want to be long the yen, okay? Then, of course, if we come down here and look at gold, um, when the value and Nasdaq, I'm sorry, value and small cap rally, we see a little bit of a bump in the gold, but I do see this holding here for a little bit. But if it breaks and goes down, we're going to probably fill this gap down here. I'm on record as saying I want to see this gap filled. You can, if I go back over here, you can see where the gap occurred. I think we'll probably settle in. If we break the 50, we'll settle in down here around the 2260, 2270 area. If that breaks, we'll come down and test the 200 by filling that gap. That's what I see in gold. Near term, mostly chopped to downward move. Same thing with silver. We want to be long silver and gold longer term. You can see silver's already broken the 50, coming down, probably going to test the 200. Right below the 200 is a key pivot point low. We'll probably test that and consolidate for a while. So that's kind of what I'm looking at there. And then, of course, if we go to the all-important energy sector, you can see oil right now. I think oil. One thing about oil moving lower is not so much it's going to reduce inflationary pressure, but oil can move lower because it's got good headlights into the economy, right? When the economy globally suffers, then oil tends to suffer. So this could be an area where we see oil come back down and test these lows down here in the low 70s. Okay, members, we have a good way of trading this, and it makes money for us. And we'll go through that again Sunday evening. And of course, if you come down here and you look at nat gas, I want nat gas to move lower. You can see here a rally attempted and failed. I think nat gas is going to continue to move lower. If it gets back down in this area here again, then we'll flip the switch and look at going long. All right, everybody, that's just a quick update on some of the key markets across different industry groups and commodity sectors. Members, I'll see you Sunday evening for our weekly market watch. If you're not a member, I highly encourage you to come in. We're getting a number of people worldwide coming in and checking us out. So that's a good thing. Everybody, I'll see you this Sunday evening. Everybody else, I'll see you next weekend for our weekly roundup. Take care, folks. Ciao now.